Welcome to the ALX Show, your premier source for DFW real estate data and insights. Let's get to it. Hello, Josh and Patrick. Welcome back to another episode of the ALX Show. Today, we are updating our economic indicators dashboard, which I am excited to reshare to everybody to see the latest data. And if you're not familiar with this economic indicators dashboard, there are about 50 different metrics that the ALX team is keeping track of and analyzing every month as new data comes out. And it's arranged from most national, broadest federal data all the way down to local DFW market data. And so what we have here is we have interest rates up at the very top. So looking at Fed funds rates and prime, SOFR. And then we see treasury yields, the 10-year and 2-year, how that's affected financial markets on the Dow Jones, NASDAQ, and S&P. And then we've got macro data. So this is like core CPI, PCE, oil, gold, lumber, payroll growth, and unemployment rate. And then we've got rent inflation. And then we start getting into the Texas economy, like average hourly earnings, population growth, et cetera. And then we get DFW single family and multifamily data. So this is like building permits, average days on market, closed sales, months supply, and then some different cap rates based on different classes of structures. So I would love to hear from the team. What's the latest data? What does it tell you? And where do we go from here?
All right. Yeah, well, the big news last week was the PCE report. It's showing that inflation is cooling. It was actually beat expectation. Headline came in under what median forecast. So your core is still a little bit higher. That we got some help with oil prices coming in, which is great. But ultimately, I think that'll work its way through to the headline number too, depending on how long oil stayed down. I know that's a little bit iffy right now with everything that's going on in the Middle East. If you look today, then oil is up, I think 4%. So we're gonna just have to see how that works out. But ultimately we got good news, and it's good because that's what the Fed wants to see. So that PCE needs to be in that 2% range. And when it gets there, I think they'll determine mission accomplished, and we'll start to see bigger Fed funds rate cuts, just like we saw that 50 basis point one previously. I think Powell came out and said that that's not likely going to happen again. We'll probably see more gradual cuts moving forward, 25% and 25% at the next two meetings. But ultimately, that just gives us a good direction and gives them stability in the credit market to where I think lenders feel more comfortable about what they're wanting to lend at. Borrowers feel good about when they go under application to buy something that the terms they get at the beginning are likely going to be close to the terms they get at close. So it just helps all the way around, right? We're going on this trend where interest rates are coming down. Macro data is supporting the move down, and it's good news for all of us in commercial real estate. And anybody that's borrowing, on the long-term index, just to give us some sense of where things are going and feel good about getting active again.
Yeah, the interesting thing to me when you look at the PCE numbers, I think the headline annual number was 2.2% and the core was 2.7. If you look at the last 4 months and annualize those numbers, very encouraging. Trend-wise, what direction we're going in. The headline number 4-month annualized is 1.2%, and core is down to 1.8%. So just shows that inflation is being tamed as everything kind of works through the system. And so don't want to rely too heavily on those annualizing short month durations, but I think that is a good sign of progress.
I think we need to talk quickly, Brandon, about what does it mean for cap rates. It's incredibly important as cap rates, spiked up over the last couple of years with interest rates going up. But we're starting to see, we're getting lots of news in now from brokers and lenders that are saying they think that cap rates have probably peaked, especially in multifamily, and are starting to come back in. Now they're probably not going to get down to I think the average was sub 5. Back in the peak of 2022, they're saying the average is just sub 6. And keep in mind that that's accounting for a lot of Class A properties that have very low cap rates still in premier locations. but it's just good news. We saw cap rates really blow out there for a while, which you'd expect with interest rates going up. But now we're starting to see indications that they're now kind of hit that peak and are coming back in. And that'll really, how far they come back in will be determined on how low that 10-year treasury goes. That's if you're Fannie and Freddie for your agency debt. The SOFR coming down helps cap rates too, because bridge debt is tied to that SOFR number. So all the rates coming in is going to ultimately compress the cap rates, which is great if you're an owner. It may mean that if you're a buyer looking to get a deal, then it's now or never, at least in this cycle. But as an owner, you're feeling pretty good about, okay, maybe a little sigh of relief, we can breathe a little bit. Values are going back up.
And you saw this too. If you kind of look at the publicly traded REITs as kind of a forerunner for where the privately held commercial real estate market's going to go, it peaked in anticipation of rate cuts that we knew were coming. The publicly traded REITs have performed real well. And I think that now owners like us, privately held investments, are starting to feel that same kind of upswing that they felt in the publicly traded markets over the last year, which is good news.
That's great. Yeah. So on the market point, markets are down today. Today, by the way, I didn't mention this, but it's Tuesday, October 1st. Markets are down a bit, but I think from what I'm gathering, it's more to do with some of the Middle East tensions. There's also a port strike along the East Coast U.S. ports that I think has some people a little bit nervous. But as far as the broader market, let's say over the last week or two, it's still performing fairly well, I think, because of what is happening in the interest rate environment and what people are seeing. But you have said, Josh, before that the labor market is something that you guys are paying a lot of attention to. Is there any fresh data that you've seen over the last week where there's maybe some more answers as to what's happening in the labor market and how that might affect rates or any kind of like near-term movements from either the Fed or markets or even DFW real estate?
Yeah. So job openings came out today, and they're actually elevated from where they were previously. And that's an estimated number. I think the biggest gains were in construction and government. But then the real interesting factor in that, now they were up, I think, just over 8 million. Previously, they were mid 7 million. But I think the real interesting one was the quits rate. The quits are way down. So anytime that quit rate comes in, it's an indication that people don't feel good about leaving their job. When quit rate is up, then people feel really good about going to another job, getting more money, really not concerned about leaving their current position. Well, that's changing. So if employees are not feeling good about the job market overall, meaning, hey, I need to stay in and just work it out here, then that's, pretty solid evidence that labor market is really slowing. I don't know that we're in a problem area. I think it's still pretty strong, but I think we're out of the days of it really accelerating where wages are way up. People are hiring like crazy. I think we're now getting into a time where companies are starting to just kind of take notice of where they are and then maybe even scale back some. So we'll start to see that the labor report comes out on Friday, and a big number there will be wage growth and how many jobs are added and things like that. So we'll see how that works itself out. Keep an eye on that quits rate. I mean, I think that tells us a lot about how people are feeling about job prospects.
Awesome. I have to ask, I don't know if this ties into anything you guys are seeing on the ground or any of this data, but with the hurricane that came through last week and caused such devastation for so many people from Florida to North Carolina and beyond, and there's been some talk about, in some industries, there's been some like plants that have been shut down. For example, there's one like quartz. There's a quartz plant for semiconductors that's in the middle of North Carolina. It seems to be in the middle of nowhere, and it's like one of the only plants in the world that does this thing. So I have to ask, have y'all seen any kind of outcome or effect on real estate markets or anything based on any kind of weather event like in the last week or so? I mean, how is that affecting what you guys are seeing, if any, if at all?
Yeah, I don't think we've seen anything yet, but I don't think that means that we're out of the woods as far as downstream effects from such a devastating weather event. Um, you'll, if there's, an impact to labor, you'll probably see that starting in data that we start to get in November, reflecting stuff that has happened this month in October. So not only weather related, but the port strike, like you mentioned, and I think
Yeah.
Boeing workers have got a big strike, and there's
Oh,
potential for a lot of noise to get created that would not look great in the next month's job report, not the one we're going to get on Friday, but the month following, which would probably not be great news if you're a certain incumbent presidential candidate right before the election.
yeah, right.
But so, I mean, otherwise, I think, yeah, you're right. These things that disrupt supply, hopefully don't have too big of an impact like they did in 2020. I don't know if anything can ever impact supply quite like that again, but there is potential that, that can create some pain and some shortages in the near term. We tend to be, I think, pretty good at figuring out and navigating alternative solutions to disruptions like that. You think about like when the Baltimore Bridge collapsed and the immediate fear of that being such a huge port and it impacting imports and exports. And we really didn't have much more than a 2 or 4 week blip to supply and kind of figured out ways around that. So hopefully the same regarding the hurricane.
Yeah, I don't think, as long as it's deemed just a short-term issue, I don't think it'll impact the Fed's kind of route, even if it temporarily spikes inflation there, just goods inflation. Yeah, I think if they can really attribute it to it's just a short-term logistical issue, and it's going to get worked out if they show progress in the discussions, then it'll likely, I think, have a minimal effect on what the Fed's going to do. We hope that but just as far as just everyday life, right? We hope that they get that worked out, because there's so many goods that get shipped through those ports, obviously, and that could impact everybody just day to day on getting just regular stuff. I will say that the hurricane, I think one place that we are kind of like, as the commercial property owners on insurance, anytime you see a major, weather event that causes a lot of damage, an insurance provider is going to come in and have to pay for all that, then there's always a concern that premiums could go up from there. And we've had, over the last couple of years, I think Patrick has written about this and talked about this before, but a lot of it being inflation related, insurers are just having to pay more for repairs, and in having to, they're now, in having to do that, they're now having to raise premiums to make up for, the extra payout. So, we're always looking at that. When I see the hurricane come in and hit, and Florida, their insurance is in trouble anyways. I think, it's just getting, so many properties have gotten hammered, but maybe a regional issue where providers, maybe just stay out of Florida, or they back off Florida a little bit, but you just never know. A lot of these providers are national providers, so it could have an impact on, what they're willing to charge for a premium here in Texas. We'll wait and see. We haven't seen any indication of that yet, but that's always, whenever we see a major weather event that affect property like that, our hearts and prayers go out for those people. We're just seeing the devastation that storm left, and it's tragic, but like I said, hearts and prayers for them. But as property owners, which is not nearly as important as, human life, human condition, but we are thinking about, okay, well, it could ultimately impact premiums in the short term.
Yeah, for sure. For sure. Yeah, my brother lives in Tampa, and then most of my family lives in Georgia. And for 2 or 3 days, they didn't have cell service. They didn't have power. They're having to move for rental. It's just, yeah, it's a major, major issue. But I sent an article to my brother in Tampa that came out in the Wall Street Journal today about, in the Tampa area, how a lot of people are just selling their homes, but there's no market for it anymore. Over the last like 2 or 3 years, they've had to cut their prices so many times. hand, their home insurance has gone up, I think 4 times since 2020. It was saying something. It was like, I don't know, it's like $900 a year or something, and now it's like $2,300 a year or something crazy. So it's something like that. I can't remember the exact number, but yeah, it's just gone up a lot.
I spoke to a highly productive, very successful mortgage provider here in South Lake, and he was telling me that the Florida home market could be in for some trouble just because of the insurance issues. There's so many old condos and homes that need to be redone, or that need to be, retrofitted to stand some of these storms, like just these really expensive windows and exterior repairs that need to be made so that they can withstand just the weather out there. And it's just expensive. And so I think people are having a hard time selling them because they need to be upgraded in certain way, and in a lot of ways, some of these very functional ways. But then too, insurance providers are kind of backing off them a little bit because it's been so expensive, to repair them after these storms. But, homeowners of Florida it's going to be interesting to see how they work that out. But I think it's really going to hurt the market out there because insurance has become such an issue and repairs have become so great, especially here lately. And this last storm was just going to exacerbate that.
Are you two watching the presidential debate, the vice presidential debate tonight? It's at 8 p.m. Central. Okay.
I'll be watching.
You mentioned the election coming up. Are you guys thinking anything, politically about how maybe some of these things are going to affect, the DFW market or either economic outlook or anything like that over the coming weeks? I mean, I know there's nothing we can really, point to specifically, but I'm just wondering how you guys are thinking through the political climate as we're coming up on the election.
Yeah, it's going to make a big difference depending on who wins. I think that's a lot of reason we see, like, if you look at the home market, it's really kind of stalled out. You've got inventory continues to creep up, and transactions are down. And I think there's 2 reasons for that. One, I think the mortgage rates, people just want a little bit more clarity on where they're going. And a lot of people expect them to go down to the low 5s over the next 12 to 18 months. So if you can wait, then you probably are. But another reason for hesitation, I think, is the political uncertainty. And once we get that worked out, there's a little bit of stability and clarity, as much as there can be ever in this world, then people feel better and start transacting again. As far as economic policies, I think that we're all for growth, working on the growth side of the economy. So we like lower taxes and deregulation. We think that spurs economic activity and really addresses the issue within the housing market, which is supply. We think that we need to spur on activity, get more supply out into the market, and in doing so, will really solve the house inflation issue. We don't see it. We feel like we're so far behind. I mean, depending on what depending on who you listen to, we could be 4, 5, 7 million housing units short of where we need to be. So we've got a long way to go. So we think that policy that's going to increase and spur on production activity is the best one for us.
Yeah. We talked about that before with Kamala Harris talking about the housing shortage as being a core component of her, platform, that it's becoming such an issue, especially at the national level.
They're having to address it. Yeah, they have to, because if you look at the inflation, what's the biggest driver right now? It's shelter. So they're having to address that issue. And it's crazy because you think that if you raise interest rates as much as they have, then you really cut off demand and that shelter inflation would come in, but it hasn't done. Why hasn't it done that? It's because people aren't moving. Like there's not enough transactions. We're not building enough, and people that are sitting with their 4% mortgage rate have no reason to move. So we just don't have enough inventory. But it's a real issue. It's a major issue, and they're having to address it. We hope that it gets addressed on the supply side.
Yep.
I think looking long term about the potential election outcome, a looming question I'll start with this. There's not a ton of detail on at least one side of what the expectation is she were to win the election, what she's going to be doing. And so it's kind of, it's tough to forecast what, a baseline expectation might be. But longer term than that, there is still a big deficit spending problem that's got to be solved. And truly, it's not something that you want to make front and center of an election if you're a candidate, because it's going to have to make unpopular decisions. And that's the biggest item out there that's looming is we've got cannot continue to grow solely based on debt and accrue amount of debt that we're putting on the books right now. And so there's going to have to be someone who steps in to solve that. And the next 4 years will probably just be more of a how much bigger does the problem get?
Well, I think why that affects us, and if you're listening to this, what does it do to the bond market? What does it do to the bond market? From there, what it's doing to the bond market, what does it do to the mortgage rates?
Here's what happens. And this is why this is like tangibly hits home right down to your mortgage rate. When we've got such a large deficit, the Treasury funds it by issuing more bonds. And I'm sure everyone knows that, but the more bonds that are issued, the less valuable they are because there's more of them to be purchased, and that sends yields upward. So all else equal, the higher the deficit, the higher the yield on notes and bonds are going to be, and that's going to trickle down to things like your mortgage. So if we were reducing the deficit and not issuing as much debt, then just by virtue of it being more scarce to obtain those bonds, which are the strongest creditworthiness in the world, yields would be pushed down further than they are today. And that would benefit everybody. And so you can see where if you're running on deficit spending by issuing a ton of debt, if you don't corral that, then long term, you see how some of these countries get spun way out of control, and you hear stuff about like 20-30% interest rates. Not that would happen here, but you see how that can happen when you've got a bunch of needs to be met, and there's so much out there that no one's willing to pay for it at a reasonable cost.
That is fascinating. I'm sure. Yeah, there's so many listeners that maybe understand that dynamic, but to put it home, make the connection between the vice presidential debate tonight and your mortgage now, and how those two things are related, when thinking about how people
very
are,
much so.
What the policies are
huge effect.
putting forward.
Yeah,
love that. Well, is there anything else that you've seen with the data releasing yesterday and today on that has really captivated your attention or made you think, oh, that's something interesting, or that was unexpected, or anything that's kind of that you're paying attention to, maybe a red flag, yellow flag, going into the next month before the new data is released?
Yeah, I haven't spent a ton of time thinking through all the implications of this, but yesterday and today, inflation numbers in the larger Western European countries are missing expectation to the low end, like significantly. I think headline inflation in Germany last month was 1.9%, and this month was like 1.5 or 1.6. Same thing in Italy and Spain, mid 1% numbers. And expectations were, significantly higher than where they ended up coming in at. So there's a big deflationary trend starting, it looks like, in the Western European countries. And so, large largely nations' paths of inflation, developed Western nations' inflation paths have kind of mirrored each other. So can we see that happening here? Maybe that's something to think through a little bit more. But in the immediate term, I guess there's some impact on import and export pricing and goods that could be coming over here at cheaper levels. And then there's also we talk about recession fears here, the slowdown looming over there too. I think the German GDP contracted over the last quarter just slightly. So just like we've seen in China, who's decided to make a big stimulus plan to spur on some growth, and they've had a great last week doing that. But there are, some global slowdown fears that
we'll see. The war in the Middle East, right? And see how that escalates over this week, and what kind of impact that's going to have on our economy and just the world in general. So there's a lot out there. We talk about world wars. We talk about the port strike. We talk about some deflationary trends in Europe. We talk about the China stimulus, the election here in a couple of months. There's a lot out there, right now, and I guess there always is. The hurricane, all right, I don't want to leave that out. So there's just a lot going on, and a lot of stuff that can impact the economy in a lot of different ways. So I think just following these trends as closely as we can, or just kind of being, like on this dashboard, just monitoring them the best that we can, and and just keeping an eye out for what's going on, and just make the best decisions possible. But there's a lot out there. That it's a crazy time. I think we all know that. Like I said, we're praying for all the people that were impacted by the hurricane. Certainly praying for Israel and the people in the Middle East, and I mean in Russia and Ukraine. I mean it's all over. So we're heart goes out to all the people that are really suffering right now. But it's a weird time. It's a lot of uncertainty, and no one knows the future. But one way that we can kind of make the best decisions of what we do have is by following this dashboard and just staying up to date as much as we can with what's going on.
Love that. Well, thank you both so much for following these stats. I know it takes a lot of work to kind of, run through everything, understand what you're seeing, and then put it in this big, beautiful dashboard on your website. And so I know there's a lot going into that, and I appreciate you guys staying on top of it for our listeners, but also for the wider DFW real estate community. You do a great job, and I'm really thankful for you both. So with that, we will see you next time to talk about some top stories in DFW real estate for investors and other listeners that we have in the community. And we'll see you then.
Thanks, Brandon.
All right. Thanks, Brandon.